It gives me great pleasure to introduce Bill Coen, Senior Advisor to Baton Systems and former Secretary General to the Basel Committee on Banking Supervision. Bill, welcome to the show.
Thank you, Jerome. It's a pleasure to be with you today.
Bill, today we're going to talk about the Basel III Capital Framework. You were one of the principal architects of this regulation. What were the drivers of your thinking as you embarked upon the revision of the regulatory capital post-GFC?
Well, Jerome, regulatory capital certainly comprised the bulk of the reforms, but I always feel compelled to remind people that the entire package was immense and included non-capital reforms like a liquidity standard, the LCR, the liquidity coverage ratio, a funding standard, the net stable funding ratio, important guidance we've provided on risk data aggregation and risk reporting, referred to as BCBS 239, large exposures, guidance on supervisory expectations, and a whole lot more. But you're right. The thrust of the reforms was regulatory capital. What was our thinking? Some of it was driven by the glaring inadequacies of the existing framework, and these were the reforms that we made were readily apparent and readily needed. Just the amount and the quality of capital. So more capital, which means a higher calibration of the required minimum ratios, better quality, better loss absorbing regulatory capital, guidance on securitizations, CDO squared, other traded credit products. And some of the reforms were searing lessons from the global financial crisis, which provided really important feedback. Just the entire credit risk framework, the operational risk framework, certainly market risk, what people refer to as the fundamental review of the trading book. Those reforms were built on enhancing the existing rules. So that was, I wouldn't say easy, but at least there was something to work with already. A lot of the other reforms we made were really new or novel. A leverage ratio. A leverage ratio had only been in existence in the US and in Canada, not in the rest of the world. And this is a whole part of the effort to take a multiple metrics approach rather than just rely on a single measure like the risk-based capital ratio. Now we've got the leverage ratio, we've got liquidity and funding ratios, and of course we've got the, I hope, the new and improved capital ratios. The whole system of buffers, capital buffers, for example, the capital conservation buffer, banks would be restricted from how much capital they can distribute in the form of dividends, for example, or share buybacks if their capital levels fall below a prescribed threshold. A countercyclical capital buffer, in theory, it sounds great, right? Banks build capital in good times. For the inevitable downturn, they'll be able to draw on that capital in less good times. So a lot of what we had done, it was driven by the global financial crisis. We were trying to think ahead, trying to make the framework future-proof, not fighting the last war. And a lot of these things, Jerome, were really based on great theory and academic research, but in many respects, we weren't particularly sure exactly how these new measures would behave in real time. The final thing I'll say, the other two elements of the framework that we adopted pertain to central clearing, banks' exposures to central counterparties, the margin requirements for non-centrally cleared derivatives. These were very consistent with the G20 call to move towards G20. So I think in the aggregate, all of these measures together really have made for a much better, far more well-informed regulatory framework.
Thanks, Bill. That's really fascinating. From my perspective, having been on the other side of the table during the formulation and implementation of these rules, as you say, it was not a straight path. It was at times very, very difficult, and a lot of very interesting engagement between practitioners and regulators as the framework came together. From where you sit today, we're in 2021 now. Are you able to say mission accomplished relative to the broader framework that you all set out to achieve back in 2010?
I think it's too soon to say that. I think undoubtedly the framework is better. The banking systems around the world are stronger. I think the experience that we've had with COVID so far, and the pressure we'd seen in the markets last year, and the considerable pressure on bank asset quality from the fallout from the pandemic, I think that was a really good test case. I don't think it was a complete validation. Keep in mind, a lot of these provisions of the Basel III framework are not fully implemented. But I think what we've seen so far, I'm encouraged, and I think things are definitely moving in the right direction.
Yeah, no, I would definitely agree. And with the latest implementation of the UMR rules, I think the last wave actually came into effect this month. Is actually, again, very much goes to your point about this is still a process that is unfolding before us. I think that leads to an interesting question, because even as we're really, as you say, waiting to maybe, declare a victory in the broader regulatory space, there's a new process that is starting that is very much focused on the digital asset, on the crypto asset space. And I guess my first question to you in this regard is whether you see this as a natural progression of the regulatory framework that you focused on during your tenure at the committee.
Yeah, Jerome, the role of crypto assets and digital assets, it's not, I know the Basel Committee just published a consultative paper a few months ago, but this is something that we had discussed. I took the reins of the Basel Committee in 2014, and part of my responsibilities as the Secretary General was to chair a group called the Policy Development Group. And the treatment of crypto assets was something we had discussed back then, 2014, 2015. This is not a new topic. And I'll state the obvious. It's imperative for regulators to keep up with the times, to have a high awareness of evolving or growing risks and bank practices, as well as market development. So this is not something that the Basel Committee just picked up recently, or national authorities just started to think about. This has got a kind of a long fuse. But for emerging or evolving issues like crypto assets, the regulatory community has to really toe a careful line. A too heavy-handed approach could squash a really important and a growing asset class. Too light of a touch could lead to really high growth in that asset class and potential financial instability or market instability. So yeah, I think the Basel Committee's approach that it published in its consultative paper, and I think it really tries to strike that balance. And this is very much a work in progress.
Yeah, it seems that actually in the paper, it's interesting. I think that they are trying to, or they are taking steps in terms of trying to strike that balance. Perhaps one of the first signs of that is the very clear distinction that the paper defines between crypto assets and digitized assets. So assets using cryptography as opposed to those digitized assets that don't. Is this a necessary distinction? Do you think that this is the right way to be wading into this particular pond?
Yeah, I think, I remember well the great sensitivity of the central banking community. Remember, the Basel Committee is housed within the Bank for International Settlements, the central bank for central banks. And the whole notion of products like Bitcoin or Ethereum's product, Ether, the whole notion of this as a currency is a very sensitive point for the central banking community. And I think you see that distinction within the paper. Yeah. That the treatment for those kinds of, for Bitcoin, Ether, and the other crypto assets, well, the view within the official sector community, the central banking community, is that there's tremendous volatility around these products. There's not they're immature asset classes. There's not a lot of experience. There's no guarantee. They're not issued by a central authority. So in other words, Jerome, they don't meet the true test of a currency. And that's why, central bankers will always refer to them as crypto assets, not a cryptocurrency. On the other hand, tokenized digital products, there's a clear link to the underlying assets, and that's why the distinction made by the Basel Committee is in my view, an important one, and that's why I do think they're trying to strike that balance. Much of what has been picked up in the press about this consultation that the Basel Committee is conducting is that it's a really punitive proposed treatment, but that's just looking at the Bitcoin Ether part of it. I think for me, the really important takeaway is the acknowledgement by the Basel Committee of blockchain, of technologies like distributed ledgers, because there I think there was a clear recognition that this is we've evolved in the financial system. There's got to be an awareness, recognition of these technologies, and I think that consultation paper really does provide that recognition.
Absolutely, it does. And I think it's a very interesting question as well, because these technologies, whether you're talking about distributed ledgers or blockchain, these are relatively novel technologies and new entrants into the way various market participants actually communicate amongst each other. It seems that the consultation paper also is taking a view as to how you consider these new networks from a regulatory standpoint this way. Is this important?
Jerome, I think there's always been a sensitivity within the central banking, the regulatory community about that sector's ability to keep up to date on technology, innovation, latest developments. You think about central bank digital currencies. I think there is this really keen, this eagerness, this keen awareness that it is imperative that policymakers and standard setters are keeping up to date with the latest technologies. I think there's no way the central banking community or the regulatory community could ever outpace the private sector. No. But at best the best they can hope for is to remain current on latest developments, and I am confident that they are. I follow what happens at the central banks around the world. My former employer, the BIS, and I think in some cases I would say they're even outpacing the private sector. So I could tell you it really is an imperative felt by the regulatory community to remain up to date. And if possible, to even get ahead of the curve. Yeah. And let me just add, sure. If you think about it, you think about prudential rules. We apply those on a bank-by-bank basis. And if a bank runs into trouble and it experiences some kind of pressure, well, there could be a knock-on effect. And worst case scenario is that it leads to there's contagion. But if you think about market infrastructure, the volumes are orders of magnitude higher than on a bank-by-bank basis. So if a payment system has a hiccup, well, that reverberates around the rest of the financial system. So I think it's important to make a distinction. You've got the use of technology at the bank level, but then the use of technology for market infrastructures. It's consistent that regulators want to stay up to date with current developments or even get ahead of the curve. But the risks, let me just say, the stakes are higher when it comes to market infrastructure. So I think there is an important distinction there.
So are you saying then that you think that there should be additional requirements from a regulatory view with respect to these emerging technologies?
I don't think there should be different rules. I just think that they take a slightly different approach if you're a policymaker preparing rules for banks versus policymakers who have oversight over market infrastructure. The common thread, of course, is market stability, financial stability, but the stakes are higher, and there's just this keen awareness that we have to use technology, we have to embrace technology, we have to keep up with the times. But I think there is also at the same time a real awareness that the stakes are quite high.
Indeed they are. Bill, we're almost out of time, and I just wanted to ask you one final question, if I could. And that is really if there's any one particular takeaway that you'd like to leave us with, relative to either your experience or what you anticipate to be, I guess, the major themes over the next few years in terms of the evolution of the regulatory infrastructure for markets, what would they be?
In a word, innovation. I think this is my theme today. We've touched on developments where we were, the global financial crisis, where we are today, and looking ahead. I just sense I'm well aware of this eagerness in the regulatory community to continue to embrace technological advances and innovation. Regulators are keenly aware of the rapid pace of change and doing what they can to remain current and to not serve as a roadblock to the benefits conferred by innovations and these advances. That there's a real mindset there that wants to follow through on embracing technology and innovation. So I think as technology continues to evolve, as will innovation, I think the regulatory community is keen to embrace that technology, those advances from innovation. So it continues to be an exciting time, and I don't see this pace of change slowing down. And I really very much see the regulatory community continuing to immerse itself in these changes.
That's great to hear, and clearly from where I sit at Baton, we're a major driver of innovation in the settlement space, and we're very excited about working more closely with the regulatory community as well as with our clients to drive the adoption of what we think result in more robust markets for everyone. Bill, thanks very much for joining us today, and hope to be seeing you again soon.
My pleasure, Jerome. Thank you.
Thank you.